Imagine waking up one morning and finding out that the price of silver dropped 10% overnight. No war, no recession, no major news, just a sudden violent slam downward. You check your portfolio, and if you own silver or mining stocks, your heart sinks. Then you start wondering, who did this? Was it the market? Was it some big fund? Or was it something much more coordinated, much more deliberate? Welcome to Macro Truth. Today, we are pulling back the curtain on one of the most quietly powerful forces in the financial world, the banks. The same banks you trust with your mortgage, your savings account, your credit cards. For years, they have controlled the price of silver. But here's the twist that almost nobody is talking about. That control is cracking. And the reason why is going to change how you see precious metals forever. Before we dive in, hit that like button and subscribe to Macro Truth. Stick with me, because what I am about to share is not conspiracy theory. It is documented fact, buried in court records, whistleblower testimonies, and the cold, hard data of the COMEX exchange. Let me take you back to 2008. While the world was focused on the housing crash, something else was happening. Inside a small group of banks, Goldman Sachs, JPMorgan Chase, HSBC, these banks were not just trading silver, they were systematically pushing its price down. How? Through a tactic called naked short selling. Normally, when you short sell something, you borrow it first, then sell it, hoping to buy it back cheaper. But naked short selling means you sell silver that does not even exist. You create fake supply out of thin air. On the commodity exchange, known as the COMEX, silver futures are traded. And the big banks were allowed to take massive short positions, sometimes hundreds of millions of ounces worth, without ever intending to deliver real metal. This flooded the market with paper silver, making it look like there was way more available than there actually was. And when supply appears high, price drops. Simple economics, but twisted by manipulation. The most infamous example is JPMorgan. In 2020, after a multi-year investigation, the U.S. Department of Justice fined JPMorgan a record $920 million for what they called spoofing and manipulation of precious metals markets. Spoofing means placing orders you never intend to execute, just to trick other traders into moving the price, and JPMorgan got caught red-handed. But here is what the headlines did not tell you. This was not a few rogue traders. It was a calculated desk-wide strategy that lasted nearly a decade. One whistleblower, a former JPMorgan trader named John Edmonds, testified that he and his colleagues would coordinate across time zones, pushing silver down before key economic reports, crushing it during low liquidity hours, and always making sure their short positions profited. They knew exactly what they were doing, and they knew that retail investors, the average person like you and me, had no chance to fight back. But why target silver? Why not just focus on gold or oil? Because silver is special. It has dual roles. It is both a monetary metal and an industrial metal. That means its price is volatile, and volatility is a playground for banks. They can push silver down to keep inflation expectations in check, because rising silver prices often signal distrust in fiat currency. Central banks hate that. So for decades, the big banks acted as enforcers, using silver as a valve to control the narrative around money itself. Every time silver tried to break out above $20, $25, $30, a massive wave of paper short selling would appear, smashing it back down. Look at the chart from 2011 to 2020. Silver peaked near $50 an ounce in 2011, then crashed to below $14 just a few years later. Was that natural? Not according to the CFTC, not according to the DOJ, and not according to the thousands of pages of legal evidence. So here we are now, 2025, and you might be asking, why is this failing? If the banks have been so successful for so long, what changed? The answer is physical demand. You see, paper silver and real silver are not the same thing. You can create unlimited paper contracts on a computer screen, but you cannot create physical metal out of nothing. And for the last 3 years, the physical silver market has been screaming. Solar panels use silver. Electric vehicles use silver. 5G infrastructure, AI chips, medical devices, all of them consume silver, and not just a little. Each solar panel contains about 20 grams of silver. Each electric vehicle contains about 50 grams. Multiply that by millions of units, and you get a staggering industrial appetite. At the same time, mine production has flatlined. There are no new giant silver mines coming online. The ones that exist are getting older and digging deeper, so the supply is shrinking while demand is exploding. Now, here's the fatal flaw in the bank's strategy. They kept creating paper shorts, believing they could always buy back physical silver later if needed. But what happens when there's not enough physical silver to cover those paper promises? That is exactly what we are seeing. The COMEX vaults that hold registered silver, the silver that is actually available for delivery, have been draining for months. In 2023 and 2024, we saw some of the largest withdrawals in history. Meanwhile, retail investors, hedge funds, and even countries have started demanding physical delivery of their silver contracts instead of just rolling them over for cash. This puts the banks in a squeeze, a real squeeze, because if too many people demand the real metal, the banks have to go out into the open market and buy it. And when they buy, the price shoots up. That is why silver broke above $30 in 2024 and has been testing higher levels. Every time the banks try to smash it down, physical buyers step in and gobble up the cheap metal. The paper game is losing its power. Let me give you a concrete example. In early 2024, the London Bullion Market Association reported that silver lease rates, which is the interest rate you pay to borrow physical silver, spiked to over 5%. That is massive. Normally, lease rates are near zero because physical silver is abundant, but a spike means one thing: there is a shortage. People who actually need the metal are willing to pay a premium to get it. And when that happens, the banks, who are short billions of paper ounces, start to sweat. Because if they cannot borrow physical silver to deliver, they have to buy it at whatever price the market demands. In other words, the banks themselves become the biggest buyers, and that is when price control flips upside down. Now, here's where it gets even more interesting. The same banks that suppressed silver for years are now quietly accumulating physical metal. You can see it in the filings. JPMorgan, yes, the same JPMorgan that paid nearly $1 billion in fines, now holds one of the largest physical silver vaults in the world. They are not doing that because they love shiny metal. They are doing it because they know the paper game is ending. They are preparing for the inevitable. And they want to be on the right side of the trade when the dam breaks. This is the ultimate irony. The banks that created the suppression are now positioning themselves for the explosion. But that does not mean they have stopped fighting. Every time silver rallies, you still see those late-night flash crashes, those sudden sell orders of tens of thousands of contracts. They are still trying, but it is not working like it used to. Each crash recovers faster. Each dip gets bought harder. The market is learning. So what does this mean for you? If you are an investor, a trader, or just someone who wants to protect your savings from inflation, this is critical. The old rule was that the banks would always win. The new rule is that reality always wins. Physical scarcity cannot be faked forever. And we are seeing a historic shift where paper derivatives are losing their grip on price discovery. That does not mean silver will go up in a straight line. It never does. But it does mean that the long-term trend has changed. The suppression mechanism is breaking. And when it fully breaks, the price could adjust violently to reflect the true supply and demand picture. Some analysts are talking about $50, some $70, some even $100 an ounce. Those numbers sound crazy only if you believe the paper market is real. If you look at the physical market, they start to make sense. Before you go, let me ask you something. Have you ever felt like the markets are rigged? You are not wrong. But here's the good news. Rigged games only work as long as nobody exposes the rules. Once enough people understand the manipulation, once enough people demand physical metal instead of paper promises, the whole structure collapses under its own weight. That is exactly what is happening now, and you are watching it unfold in real time. At Macro Truth, we do not just talk about what happened yesterday. We focus on the forces that will shape your financial future tomorrow. So if this video made you think differently about silver, do me a favor. Share it with someone who still believes the price is purely market-driven. And drop a comment below. Tell me, do you own physical silver? Or do you think the banks will find a new way to control the price? I read every single comment because the conversation is just as important as the video. And if you have not already, hit subscribe and turn on the bell. We have a lot more coming on gold, on the dollar, on the quiet wars being fought inside the global financial system. Thank you for watching Macro Truth. Stay curious, stay skeptical, and always look for the physical.